Hi guys, I'm back today with another investment related video. This time with a question that I get very often from beginners, and that is gold a good investment? So I will open my computer and show you a few pieces of data that I'm looking at to show you why I think gold is an absolutely shitty investment long term and you should not even bother looking at it. I just want to stress out that everything in this video is my personal opinion and is in no way financial advice. Okay, so what are my problems with gold? Now, the conventional wisdom is that gold is the absolute best investment, and a lot of beginner investors automatically think about that asset when you tell them about investing. It is in many people's heads the gold standard, pun intended, of investing. So why do I think it is shit? Number one, because proponents of gold are picking and choosing exactly what time frame and what type of information they are showing you in order to display that gold is better than the S&P. And it's true that in certain time periods and in certain conditions, gold has been a better investment than the stock market. But if you take a long enough period, or if you take the whole history of the stock market, that is not the case at all. And number two, when they are showing you the returns of the stock market in these comparison charts, it is without applying compounding to the stock market investment. And nobody realistically invests in such a way. Everybody reinvests their dividends and lets their investment compound, which stock market investments do compound, unlike gold. So let's hop on the computer and show you exactly what I'm talking about. So I've taken the liberty of opening a few calculators which allow me to see the cumulative return of each asset. And I've done that for the last 30 years. So if you are investing for the long term, 30 years is a good time frame. In the last 30 years, which is from 1993 until today, gold has returned almost 500%, which is impressive indeed. That makes up for an annual gold return of 6%. But when we take a look at the same period and the same cumulative return of the stock market, we'll see a very different picture. And here I have the same calculator, but with the S&P index this time. And we can see here, for the same period, the stock market has returned 770%. And that is a significant difference, but that is ignoring the fact that we are going to reinvest the dividends that we've had from our investment. So with dividends reinvested, that number grows to 1,432% total return for those 30 years, which makes for an average of 7.4 without reinvesting dividends or 9.5 with reinvesting dividends. So you can see how compounding completely changes the picture of which asset is better in the long run. Sure, gold's almost 500% is pretty decent, but when you compare it to 1,432%, it kind of puts things into perspective of why gold is long-term a shitty investment. And I'm not saying that gold is not useful in particular cases, because it is, but it is only performing well when there are periods of geopolitical instability or high inflation. And we are in such a period right now, and we have been in such a period many times over the history of the world. So it makes sense to have maybe 5 or 10% of your portfolio in gold if that is what you wish. But to have all of your money in gold means that you are missing out on enormous returns from the stock market because you are not taking advantage of compounding. And if we adjust those numbers for inflation, things start to look even worse for gold. Let's do that and calculate the same period adjusted for inflation only yielded 177%. That means 3.4% per year. For a supposed inflation hedge, that is pretty poor performance. And when you go to the S&P and do the same, obviously its parameters will also drop, but are still significantly better than gold. the total return is almost double, and when you reinvest the dividends, it is almost 5 times as much. So that makes for an annual S&P return of 6.8 with dividends reinvested and adjusted for inflation. If we want to visualize that in terms of a chart, here is something that I want to show you that can help you better see the huge difference between the two. So these two charts here. The first one, again, is stocks versus gold and silver. We can see that there are clear periods, like between 2008 and 2013, where gold has definitely outperformed the market. But through most of history, gold has significantly underperformed the market. And this is without dividends reinvested. This first chart is just the performance of the asset without the dividends. And then from then on until today, like we said, for gold, almost 500%. For the other ones, for the S&P is nearly 800%. So this difference right here, let me just zoom in, is quite significant over a 30-year period. And if we go down a page, here we can see the same chart, but with dividends reinvested. And that is the black line here, total return index. Again, same scenario. If you go back to the Great Recession until about 2013, gold has outperformed this index. But historically speaking, we can see gold is underperforming to the whole market. And then from 2013 on, the cumulative return is almost 1,500, while gold, as we said, is about 500. So you have returned 3 times as much in 30 years if you've reinvested your dividends and you've invested in stocks instead of gold. So where does that leave us? What is the TLDR? Well, gold sucks as a long-term investment, because if you take a look at any long enough period and you take into account compounding and investing your dividends, because everyone does it like that anyway, then the clear winner is investing in the stock market. While if you pick and choose specific periods and specific metrics, of course you can make it look like gold is outperforming. And I'm not a total gold hater. I will admit that it is beneficial to have a certain percentage of gold in your portfolio if you want to make an all-weather portfolio which will compensate for drawdowns in the market, because gold and the market usually have an inverse relationship. So when stock markets are doing bad, gold is doing well. So if you want to keep your portfolio stable, it makes sense to have a little bit of gold. And as we can see, during periods of instability, gold has some benefits. But if your only investment is gold, then you're not really doing much. That if you want to invest in gold, if you believe in the asset, do something like the Ray Dalio all-weather portfolio, where you have a very small allocation of gold just to keep your portfolio fluctuations and volatility stable. Other than that, as a pure investment over the long term, it simply does not perform as well. So gold is essentially only a hedge during periods of instability and inflation. And that itself is also sometimes arguable, because it does not always behave in the way that you would expect it to. So the bottom line is, if you want to make a better investment long term, you buy the total stock market instead of buying and holding gold. Because in that way you can take advantage of compound interest. And I will send this video to every single person that asks me whether or not gold is a good investment. By itself? No, absolutely not. As part of a holistic portfolio strategy? Maybe. As a hedge to keep your portfolio value relatively stable? Maybe. But that again will depend entirely on your goals and how you construct your portfolio. So that is it for this video. Thank you so much for watching, and I'll see you next time.